In this presentation, as we get at the end of the semester, I would like to go through what I like to call the reflection of the Gen Inc. case study series from A through G as you've gone through it, and talk about each one of them very briefly, more as a refresher, so you can refresh some of the learnings from these individual case studies. So we started out with part A, where Sarah, who was hired as a general manager to run Gen Inc., and as you recall from the case study, she started to get into understanding the financial parameters and the details of Gen Inc. In part B, we wanted to analyze, based on some of the economic softening, how Sarah, had to deal with price pressures and explore the impacts on financial performance. In part C, we went beyond looking at income statement for just 1 year and start to do a pro forma, or the forecasting, for 5 years for income statement, cash flow, and break-even quantity. So we learned how to do that. So that was one of the learning outcomes. In part D, Sarah gets ready for a meeting with board members to discuss financial ratios, ROIC, and weighted average cost of capital. So we started to learn about those ratios in that case. In part E, Sarah explores investment opportunities to enhance financial performance, applying net present value and internal rate of return. In part F, Sarah estimates the value of a company called Max Inc. that she's considering maybe acquiring it to see how to apply the enterprise valuation methodology. In part G, Sarah and her team conducts a preliminary investment analysis for the acquisition target to see if they combine the Gen Inc. with the Max Inc. and the combination, if they can create some synergy, especially cost synergy, how will that affect in deciding how much should they pay for the target company they want to acquire, in this case Max Inc. So let's start out with part A. In part A, the learning outcomes included calculating common sizing income statement and using results to evaluate the drivers. The common sizing, or sometimes also called standardization of the income statement, and same can be applied for the balance sheet. It allows us to normalize it, so we can look to see if I take income statement where the sales or the revenue is the anchor at 1 or 100, we look at all the pieces of the income statement compared to the sales, and it tells us what are some of the big drivers. We can also use the common sizing to compare a company's performance over the last few years to see, because sales values and numbers may have changed from year to year, to make an apple-and-apple comparison to see the performance. You basically normalize every year to see, is our cost of goods sold as a percent of sales getting better or worse? Is our SG&A getting better or worse, and so on? And same can be done when you want to compare company A with company B. So common sizing allows us to be able to normalize things for different size companies. But it is important that when you're comparing company A with company B, you want to make sure they are in the same industry, because the economic pressure, what happens in industry, the competitive forces are going to be different in different industries. So you cannot compare company, let's say, in the banking industry with, say, an auto industry like a General Motors. We also learn about looking at the compound average growth rate, which is typically called CAGR. Why was that important? Because it allows us to see, if I look at each of the components, how does it grow? We also looked at the understanding what are the components within the income statements, the cost of goods sold, your research and development, your SG&A, selling and general administration, interest expense, and taxes. And then in this case, we also started to understand how the organizational budgets are connected with the income statement. And understood what is the fixed cost, what's the variable cost, what's the break even, and so on. So what you see on this chart are some of the graphics from the case study. You have your connectivity between, obviously, the organization has organizational structure and departments, and they all have budgets that they have to run. So, each organization has a budget, and the components will depend upon the type of expenses they have in their particular department. Could be direct labor, could be salary and wages, could be procurement, etc. And all this obviously is connected to the income statement, because how they manage their budget, how they run it, obviously will affect the income statement, which all is connected to the management. So you always want to think that whenever you are looking at an income statement, it is being managed by a group of people, the management team, and the individual pieces are being managed by different departments, and they are also connected to the budgets of the organization. So once a company sets the profit targets and they know what sales they can sell, they can then back into and figure out what is going to be the budget for the business, and then they can then break it out into the budgets for the specific departments. In part B, we said, okay, let's try to understand some of the variables changing. If I change independent variable like a price or a quantity, what happens to the EBIT and net income and so on. So the learning outcome here was evaluating impacts on profitability due to price and quantity changes. Evaluating impacts on break-even, again due to price and quantity changes, conducting some what-ifs and exploring the impacts on the gross margin, overall profitability. And this was, again, we talked about it in Strategic Connectivity Part 1. I talked about this chart on the left in quite a bit of detail. But here, basically, we are looking at the income statement graphically on the left side. And so this way, by looking at it graphically, we start to get a pretty good feel for that we want to drive the performance of the income statement. Obviously, we want to focus on what you see on the very, very left side, the price or quantity, the labor costs, the purchasing costs, the administrative costs, and so on. Now, cost of goods sold typically, especially for the manufacturing company, is going to be a big number. In that situation, you want to, if you can, obviously break it down into smaller pieces so you have a better feel for what is in there. Now, this Jennings case, because it is a small company and case study had so detail, we can break out the pieces of cost of goods sold, which typically would be labor costs, material costs, operations type people, and salary and wages. These would be the salary and wages people like supervision, quality manager, manufacturing engineer, some overhead like cost for running the equipment, the heat, the light, and so on. Now, in a case study, if you do not have it, obviously, then you don't have a choice. You can look at it at a cost of goods sold level. But if you are in a real world, you want to start to see, and data is always available in the company. So if you're working for them or if you're consulting for them, you should ask for the breakdown so you can see what the big drivers of cost of goods sold are. So the benefit is that obviously you can do a further precision analysis of how you want to improve things. In the Jennings case study, in order for you to understand the key elements of cost of goods sold, I've given you the breakdown, as you recall, as you've gone through the cases. Now, we also obviously started to apply the normalizing or the or the common sizing of the income statement again over here. We also did the break-even analysis. We did some what-ifs conducting to see what happens if the sales are up or down, or cost is up or down, and what's going on. And obviously, it is really, really important for financial analysis to be able to do what-ifs. The question sometimes comes up is to say, what should I do what-if around? Obviously, you want to do what-if around relevant information. But relevant information is that when we are looking at estimating our income statement or the cash flow, we're basically making some assumptions. How many will we sell next year? At what cost are we going to make it next year? So some of these parameters could be soft in the sense these are our estimates. And hence, what if we were wrong in our estimates by the time we get to the next year? So some of the parameters where we are making some assumptions, and again, these assumptions are not taking, randomly from thin air. They should be based on some kind of analysis or some kind of a research to look at the what the industry growth rate is, or what has company done in the past for the growth, to use some evidence to be able to make the decision for what the future price of future quantity will be. But even then, obviously, we are basically still estimating. So those are the kinds of things you want to do. What if? What if my price instead of being X dollars is going to be 10% less? Or what if instead of selling X unit, I'm going to sell 10% less units? So this way you can kind of range bound your analysis to get a feel for that if things do go one way or the other, how does your financial data income statement look like? In part C, we decided to kind of look beyond 1 year. Creating a pro forma. Pro forma basically means forecasting. And in order to do that, you obviously apply time value of money. You calculate the future value using the present value and the rate and the N and so on. So you learn to forecast income statements, cash flow, and again, obviously break-even quantity for 5 years instead of 1 year. So here's an example, from the assignment where you were given 3 years worth of data. And obviously, I did not give you the formula, so you can learn to apply the formulas. But the whole goal was to look at the components of the income statement, the break-even, everything, not for just 1 year, but to look at it for 5 years. And also looked at it on the right, the average annual compound growth rate, so you can kind of feel for, how each parameter is growing over the 5-year period. So that is important. For example, the reason it's important is that one can say, what is my sales growth over the last 5 years? Let's say the sales are growing at 10% a year, but your cost is growing at 20% a year. So the cost is growing at a much faster rate than the sales. Then it will have a negative effect on the bottom line. If it continues to grow, if the cost continues to grow at a higher pace than the sales, and eventually a business in making profit will start to, not make any profit and start to lose money. In part D, we started to get into some of the key ratios, like ROIC and WACC and few working capital ratios. Here, the learning outcome was or is that the financial ratios and the connectivity between income statement and the balance sheet, working capital, cycle times, cash flow conversion, profit ratios, profit margin, ROA, and so you did this calculation for the Gen Inc., and we also did the calculation for weighted average cost of capital and ROIC. So ROIC, as a refresher, is the operating income, or basically EBIT, which is same as operating income, times 1 minus tax rate divided by invested capital. Invested capital is equity plus interest-bearing debt. Now, WACC, on the other hand, is the calculation that you did, and I have a separate video on that. We'll be looking at the weighted average cost of debt and weighted average cost of equity, and we come up with the average cost. The RD is the cost of debt, and the RE is the cost of equity expected by the investors, and the V is the combination of total debt and equity. And again, debt is going to be the interest-bearing debt, so we will not include accounts payable. And and equity is the investor's equity in the balance sheet. Now, on the right side, again, debt should be interest-bearing, so you'll always exclude accounts payable. Now, obviously, if you take that and apply your basic accounting 101, where assets is equal to equity plus debt, or change it around and equity is equal to asset minus debt, the invested capital basically mathematically will become assets minus accounts payable. I mean, you don't have to go through the math, but at least you should be aware of it, that invested capital basically is assets, but we will take out the accounts payable that is on the other side of the balance sheet. We'll take it out because accounts payable is not invested capital. It is accounts payable is the money that we owe our suppliers, so it is a debt, but it is not interest bearing in the sense that we don't pay interest to our suppliers for having a contractual agreement that we can pay them over 30 days or 45 days. So that should be taken out of the invested capital. So now how do you improve ROIC? ROIC can be enhanced by improving, obviously, if you look at the formula, the EBIT or the operating income. and or effective use of assets. Moreover, as a company has leverage over suppliers, obviously if they can get the favorable terms for accounts payable, obviously that's also going to help the invested capital, which is in the denominator, and that will also help the ROIC to go up. So in the case, you calculated, the invested capital, you did the ROIC, the questions that you had to answer, the WACC, you looked at all the working capital ratios, so you had a pretty good feel for all these key ratios and what they mean. And, and much of this is really connected to free cash flow, which we started to apply later on in the future Gen Inc. In Part E, we wanted to learn about how to apply NPV and IRR. So here, some of the learning outcomes were from the prior cases. So they were repeat learnings, the pro forma forecasting income statement, using cash flow formula, WACC and ROIC, which we learned in Part D. The new learnings were applying WACC and ROIC, conducting investment analysis using NPV and IRR, and so this was and evaluating the impact of strategy on the financial performance. Now, there in that same week, you also had the Gen Inc. case study, with the fundamental enterprise evaluation, which talks about in quite a bit of depth about ROIC and how it is connected to WACC. And this conversation also is connected to Strategic Connectivity Part 2 video that you may have listened or should listen because it has a connectivity there too. So in that Part E, one of the projects we had was to say, if the company is going to invest in a software, ERP software, that's going to allow them to make their HR activity more efficient. So there was some costs associated with the training. So so we basically added these into our income statement. The SG&A startup cost in year 1 was $20,000. In year 2 was $10,000. These would be things like for the training and things like that was defined in the case study. And there was some investment in the software that was going to get depreciated over the 5 years. We assumed straight line, at least in the case study. So that's what you see as $20,000 for the 5 years. And then the savings we estimated, or at least the case study provided, in the real world you would estimate it, was $50,000. So basically that's a negative number. Why? Because there is a savings, so we will make the expenses less. And from there, we basically started to create the operating cash flow. Now, then to do the NPV and IRR, we need the discount rate. In the example that you did, we started out by using 25% as a hurdle rate. Obviously, the final one you did, you used the 40% because it was, around what their ROIC is, which is about 38%. So here you basically, first you look at the as is, which means if you were not doing this project, what would your cash flow look like? Where did that come from? That basically comes from the pro forma. What you did in the Gen Inc. Part C, where you did the pro forma for 5 years. But then you're looking at it by doing the project, what would the cash flow be? You calculate the cash flow, operating cash flow, but you also account for any change in operating cash flow, which is the difference between as is, which is the baseline, and that. And the investments that were made, $100,000 that was required to purchase the software that you spend in year 0, which is what got depreciated, as you recall, from the income statement of $20,000 a year for the 5 years. And then we look at the net cash flow, which is really the sum of these numbers. And you get this yellow line, which is the cash flow, also called free cash flow. And then we use that line, the yellow line that starts with 115 negative and 35 positive and so on. And using the discount or the hurdle rate, which in this example we use 25%, which is shown on the top over here, we calculate the NPV and IRR. NPV came out to be 6.7 negative. So based on the criteria of NPV, based on these conditions of cost and the savings, this project will not be acceptable. And as you would expect, the IRR will be less than the hurdle rate, which is 22%. So for these boundary conditions, one would say that if we want a hurdle rate to be 25%, and if these are the conditions for the benefits and the cost for this project is not acceptable. So typically what you would do in the real world or from a strategy perspective, you would start to rethink the project. Can we get more savings out of it? Can we figure out a way to go and negotiate a better deal with the supplier from from whom we are buying this software? Can we get it for 80,000 instead of 100,000 and start to do that to be able to get to that point that your NPV is acceptable? So cash flow is the driver, which comes from obviously doing the forecasting and doing all the number crunching, and then we calculate the NPV and IRR using the data in Excel. In part F, Sarah estimates the value of Max Inc., a company she's considering acquiring. So learning outcome obviously here is that we want to know how to do enterprise valuation, equity value of the company. So obviously there is connectivity from the prior learnings. We are applying NPV, ROIC, weighted average cost of capital, we're doing pro forma, and so on. New learning is we're applying free cash flow, NPV, and terminal value, which is something new you learn in this part of the semester, to calculate the enterprise valuation, the equity value of the company. So starting with the free cash flow. The free cash flow formula is EBIT after taxes plus non-cash expense, which is your depreciation, subtracting any investment we are making in capital to run our business, and any investment in the working capital, which is adding more inventory or accounts receivable and so on. So let's talk about each one of them, starting with the EBIT piece of it. So EBIT piece of it is really, as you learned from the prior module, EBIT plays a key role in the financial performance and thus the valuation of the business. So if you have viewed the strategic connectivity part 2, I talk in more detail about this stuff. So as part of the assignment for this week is you have to do a reflection paper on both these videos, this one, Gen Inc. reflection, and also strategic connectivity part 2, and there is some overlap between the two, so you will have to do reflection in terms of your learning from both of them. So please do that. Now the business managers, leaders should obviously manage the components of EBIT to enhance the value of the business, right? Now the second part, the non-cash expense and capital expenditure. So mathematically, when you have a depreciation, you add back depreciation because of the non-cash expense. Now, when you're valuing a company versus starting a new project, you got to think slightly differently. Because in a startup phase of the company will spend capital. They're going to buy new machines, they're going to build factories and so on. But after a while, they will be in a steady state condition. An ongoing basis, company will have to replace equipment, and there will be ongoing capital expenditure. And obviously, so if I'm looking at a company, I want to buy it, obviously I will try to forecast their 5 years to see what the company will look like so I can estimate the value of it. I will have to make some assumptions for, hey, how much capital will they spend just to sustain the business? And a rule of the thumb that companies use is that on a sustaining basis, capital expenditure they will spend will be equal to the depreciation. So what does that mean? For example, if on an ongoing basis the depreciation is 500,000, one can assume in an ongoing basis that capital expenditure will be 500,000. So thus this washes out. So the non-cash expense and capital spending in the formula above kind of washes out. And this rule of the thumb is a good assumption to use. A lot of companies do that. Now, is it exactly the same in the real world that every year the depreciation is equal to the capital expenditure? No. Some years may be a little bit higher or lower, but on average, over a long horizon, at a sustainable level, to sustain the business, they will do that. And obviously, once they start to grow the business, if they want to invest in a new project, then obviously they will spend more capital, like we did in the Gen Inc. Part E when Sarah was looking at investing in a new machine for $1 million, and the purpose there was to get labor productivity. That obviously is not considered the ongoing project. It is more there for enhancing the productivity. So obviously in that case you have to account for it separately. But if you're looking at the value of the company like we're doing with Max Inc., we are looking to see what is this business's ability to create free cash flow. We have to make some assumptions for how much capital they will spend. And rule of the thumb is you look at the depreciation and assume they will have similar depreciation all the way through, similar capital expenditure all the way through, and that's a very good assumption. So what does that mean? What that means is the two parameters that are really, really important for the free cash flow are the EBIT and investment in capital, because the one in the middle obviously will get washed out. So from that point of view, now let's talk about investing in working capital. So what is working capital? Working capital is the inventory plus accounts receivable minus accounts payable. And again, in the corporate finance book, they talk about it in detail, and I know this was also covered when you took the managerial accounting course, MBA 633. So those are the three pieces of the working capital. Now, in terms of forecasting, how do we come up with what the future working capital will be? So when business grows, sales go up, the company has to invest in working capital. For example, as sales grow, they will need more inventory, and their accounts receivable will go up. I mean, that's a good problem to have in the sense that you're growing your business, and hence you may have to carry more inventory. Let's say, for example, a retail departmental store has got 20 shelves of clothing, and now they want to grow their business, so they added more space and they added 10 more shelves of clothing. So obviously when they do that, they need to spend money on more inventory to fill these 10 more shelves. So that's why as the business grows, the need for working capital also goes up. And what you're looking for from a cash flow perspective, from free cash flow perspective, you're looking to see how much is your working capital changing year over year. The change in working capital, from prior to this year, that's what you're looking for. So for example, change in working capital between year 1 and year 2, you basically look at working capital in year 2 minus working capital year 1, and that's your change. For example, getting back to my example of this retail store, if the working capital for the 10 shelves, they had, let's say, inventory of $1 million. And now they added 10 more shelves. So now instead of 20 shelves, they got a lot more shelves. So let's say now the inventory went up to $1.5 million. So they were at $1 million, but now they need more cash to add another $500,000. So the change in working capital in the example will be 1.5 in year 2 versus 1 million in year 1. So change in working capital is going to be $500,000. So that's what you use for cash flow forecasting, is the change in working capital. Now, in order to calculate what that will be in terms of pro forma forecasting, one can use the ratios that you learned. We covered it in the Gen Inc. Part D, where you looked at the inventory turnover rate, accounts receivable turnover rates, and so on, and that's what you apply over here, and that's what you have done in Gen Inc. Part F. So what you're doing is you're using the inventory turn formula. Inventory turn formula turnover is that you take your cost of goods sold from the income statement and you divide it by the inventory. So now, if we know what the company is turning as a inventory turns, so we have that data, which is the left side of the equal to sign. We know the cost of goods sold, which is we have forecasted that in our income statement. So we basically can calculate the inventory by just moving the formulas around. Inventory will become cost of goods sold divided by turnover. So you can do the same thing with accounts receivable turnover, sales over accounts receivable is the ratio, and you can back calculate it. And that's what you did in Gen Inc. Part F, so you know how to do that. So this way you can use the forecasted sales and forecasted cost of goods sold to figure out what is happening to your inventory, and what is happening to your accounts receivable. For accounts payable, the formula is cost of goods sold divided by accounts payable. And that is typical, it is in the textbooks and so on. And if you do not have any other finer detail, you can do that. But in the real world, we want to get the piece of cost of goods sold that is material. And the reason that is important, that the material cost is what we buy from our suppliers. So accounts payable value is really tied to the material content. But sometimes in a case study, they may not give it to you, so you can use cost of goods sold. In this case study, I have broken it out for you. And hence you would use material cost as a part of the calculation. So the accounts payable turnover will be material cost divided accounts payable. And for Jennings case, obviously, as the detail is provided, you can use that. So once you calculate each one of these pieces, then the working capital is inventory plus accounts receivable minus accounts payable. The reason accounts payable is a negative, which means that it is not something that we have to put our money in, is because the suppliers have given us material and we don't have to pay them for so many days. So it basically they are helping our cash flow. So from there, working capital we calculate for each year, and then we look year-over-year calculation, right? And so change in working capital, obviously, like I mentioned earlier, it's from the prior to this year. You're going to use this formula, like I mentioned again over here. Now, in the case Jennings Part F, this is a cut and paste from the Jennings Part F. Once we know the cash flow, we can calculate the enterprise valuation. And how do we do that? We do it in steps. So we got the cash flow, obviously. We've done the cash flow calculation. We did that. So from there, we can, whatever discount rate we are using. In this example, I'm using 15%. Again, discount rate is a hurdle rate, and typically you want it to be equal to your ROIC. And again, I talked about a little bit more in the strategic connectivity part 2. Is something on ROIC and hurdle rate and so on, so please watch that. But here, from a calculation of the enterprise valuation, the discount rate, mathematically, to do we assume the 15% for this particular project. We calculate the NPV and it came out to be 594.43. So what does that mean? The net present value of the stream of cash flow, starting at 120, 130, 140, and so on, at a discount rate of 15% or the whole rate of 15% gives us a positive 594.43. Now, in order to calculate what happens beyond 5 years, we calculate the terminal value. So the terminal value is calculated. Again, you know how to do that. I'm just kind of refreshing it here for you. You did it in Jennings Part F. And here we need another piece of information, that is the growth rate. What is going to be the growth rate beyond the last year of our calculation, which is the year 5? So the formula in the blue box, the enterprise value at that point, which is the terminal value in year 5 will be calculated using the future cash flow in year 5 times 1 plus the growth rate, what we are assuming the business to grow from that point on, dividing it by the difference between the hurdle rate or the discount rate and the growth rate. So if we use 3% of the growth rate, we will get the terminal value of 1304. And how would we have done that? The future cash flow, which is the FCFN in the formula, which is at the year 5, will be 152. G is going to be 3%, R is going to be 15%. When you do the calculation, you will get 130467. But remember, when we're looking at the valuation, we are looking at it at what is it worth today. So we need to know the present value of that number. Just like we did the NPV of 594, it is the present value today in year 0. So we want to take the terminal value we calculated, which is 1304, and bring it to today's value, which basically means that we can use the Excel where the future value is 1304. The R is the discount rate 15%, N is 5 years because it's 5 years away, and the present value, which will be the terminal value today, will come out to be 648.65. So an enterprise value has got two pieces. The net present value of the cash flow in the forecasted period, which in this case is 5 years, and then the terminal value from beyond that, which is 648, after we did the present value calculation, and we add it up. So the terminal value is 1243. The equity value basically is your enterprise value minus the debt. You get the equity value. It's comparable to, let's say, if somebody had a house and the value of the house was 300 and they had a mortgage of 100, the equity will be 300 minus 100 is 200. So that's the equity value is done. So in there, this is the cut and paste from the Jennings part F, you basically, went through and you calculated the pieces of the future cash flow. I mean, the free cash flow. You did the EBIT calculation. The ongoing capital expenditure basically is the same as the depreciation. Your inventory calculation using the formulas, we talked about it. From there, you look at the change in the working capital, how is it changing year over year, and from there you did the free cash flow. And after that, you use the discounted rate in this example that I gave you to replicate what I call the replication exercise. We gave you the hurdle rate of 30%, the growth rate of 3%, and another case to run the same thing with the growth rate of 5%. And so you basically calculated the enterprise value, you calculated the equity value, and so that was the learning from this particular case. Now we get to the last one. Here, Sarah and her team are conducting an investment analysis for an acquisition. Learning here is applying the ROIC, there should be a C in there, and WACC, NPV, IRR, applying EBIT and so on. Calculating the cash flow with and without synergy. So the new learning over here is we're going to take company A, which is Gen Inc., and take company B, which is Max Inc. We're going to combine it, and we're going to see if there is any synergy we can get by combining the company, and what does that mean from a financial analysis perspective. So that's what the whole idea there is. So the steps you take when you do that for acquisition conversation. You basically calculate the enterprise value for your company, Gen Inc. You calculate the enterprise value for the target company. In this case, we're calling it Max Inc. Then we combine those two, but we also include synergy benefits and check to see if the enterprise value after synergy benefits are greater than the sum of the two companies minus the price that you're going to pay for the company. So I'm just going to spend a few minutes from a strategic thinking perspective. When we get into the strategy class, you are going to learn, some of the concepts of strategic planning and strategic concepts. One of them is PESTEL, and I'm not going to spend a lot of time over here. Basically, you're looking at the industry and seeing what are some of the elements that affect the industry. From there, you start to think of some strategic choices you can make. Basically, what protocols, how to compete. That should say how to compete, not complete. Which direction you're going to take, using Ansoff's model. What methods of the growth will you be for the company? Are you going to acquire a company, or are you going to try to grow the company from investing and developing your own product? If you start to use the Ansoff model, you'll learn about that. Do you want to take your product that is within the same markets and same products and, do more market penetration, or do you want to create a new product, or you want to do market development, and so on? So you'll learn about those things in the future class. But here for this case, basically because it is not a strategy class, I have provided some conditions. I basically said that they want to grow from acquisition. So the method of growth they've decided is acquisition versus organic. Organic basically means that they want to grow basically developing their own product, etc., etc. Acquisition means that they're going to go acquire a company. And also, acquisition can be in the same industry or could be an unrelated industry. In this case, I said it's going to be in the same industry. And those things will become obvious to why those are important, because the assumptions you're going to make for your synergy savings will depend upon is a company in a related industry or an unrelated industry. A related industry basically means that both companies are in the same industry. A GM buying, let's say Nissan, it would be related industry. A GM wants to go buy, let's say Yahoo, obviously is unrelated industry. So the strategy that you start to think about in the strategy class will be to obviously, as is, do nothing, or you develop it yourself, or you create some kind of a cooperation with somebody, or you can create some kind of an alliance with somebody, or you may decide to team up with somebody and you create a joint venture, a separate company where, forming a joint venture, or you can go acquire a company or merge your company. But when you're doing it, always keep in mind what you have learned about the cash flow. Because no matter what you do, somehow in order to get the value of your strategy, you have to make sure that you're enhancing the free cash flow. Okay, so always keep that in mind. So here, where you want to think about it, obviously there are different strategies you can have. You can have developing in-house something, or you can have an alliance, you can have a joint venture. You can have acquisition and merger. For each one of them, you want to ask yourself, if I do that, what is going to happen to my sales? What is going to happen to my cost of goods sold? Because you have to at least be able to estimate the impact on EBIT and inventory and accounts receivable and accounts payable. But that's going to allow you to create the incremental cash flow. So in the Gen Inc. Part G, we are going through an acquisition. The same can apply with the merger too. So here you can consolidate the two companies into the one. So we take company Max, Gen Inc. and Max Inc. and we put it together into one company. Overall, obviously, someday you will have one CEO, you'll have one department for HR, one department for accounting, finance, and so on. So you're consolidating it. So what are some of the things, so what happens is that when company acquire, let's say when publicly traded company A acquires another company B, they end up paying more than what the company is worth at the time of the procurement. What does that mean? The stock price of any point in any time is the valuation of the company. But typically they're going to pay a much higher price to be able to acquire the company, somewhere between 25 to 30%. You had a couple of examples in the last year or so. Amazon buying Whole Foods, they paid 27% premium. CVS Health, they paid cash and stock, but the overall, that represented a 29% premium. So typically, assuming that a publicly traded company A buying a publicly traded company B, will they pay about 30% premium? Yes, research will show they do that. Some could be even higher, some could be a little lower, but assuming 25 to 30% is a very plausible assumption. Now, to offset the premium they are paying, they have to justify it through synergy. What does that mean? This means that now the management of the combined company have to come up with incremental cash to offset the premium. Now, where does this incremental cash come from? It comes from potential synergy created by combining the two companies. For example, if company A bought company B at a 30% premium, what does that mean? Prior to the announcement, let's say the company market value was worth $10 billion, but they paid 30% more. They paid $13 billion. So the premium they paid is $3 billion. And hence now they have to offset it. So basically you're looking to see if the net present value after the synergy savings are they greater than or at least equal to the net present value of company A and company B and minus the premium paid. Now, in the case of Max Inc., it is a private company. So in that case, you don't have a conversation of the premium you are paying. A conversation is how much are you paying to buy the company. So in that case, we can do that. But in either case, there are certain approximation one can use for synergy savings, especially for cost savings. So let's look at each of the components of EBIT and the working capital. Again, why am I picking those? Because remember, free cash flow is driven by EBIT performance and the working capital. So that's what you want to focus on. So cost of goods sold synergy will depend on the type of acquisition. If an acquisition is in the same industry, which is called related acquisition, like Ford buying GM, there are more opportunities for combining factories, supply chain, etc. And overall reduction could be around 7 to 10%. So one using 10% for something in a related industry is very, very plausible. Now, if you have detailed data available, which you may not in a case study, but in the real world you will, you can make a finer breakdown and typically assume labor to be about 10% and material to be about 5%. Overhead reduction, you can assume 10%. Now, it was unrelated business like CVS buying Aetna, then obviously it's kind of difficult to justify if there's going to be a lot of reduction in cost of goods sold, because Aetna has got a very different value chain, and CVS, which is a drugstore, has got a very different value chain. So there, the cost of goods sold synergy will not be there, much. Now, SG&A function is there. Typically, you find most of the synergies because it is easier to combine the HR functions, the finance functions, the corporate office, the marketing, sales, and so on. And again, depends. If it's related, same industry, you can assume 30% reduction. And what does that mean? You take the SG&A function of company A, add it to this SG&A function of company B, combine the numbers, and you take the total number and divide by 30%. I reduce it by 30%. So let's say company A was SG&A was 50, and company B was also 50. We add them up, the combined SG&A will be 100. It is plausible to assume that over a year or two, you can combine the organization and reduce 100 combined costs by 30%, and it will become 70. If it's unrelated, then you will have less of a synergy. Why? Because yes, there will be synergy in some functional departments like accounting, finance, legal, corporate office, but some of the other ones like marketing and sales will be different. For example, sales for CVS or marketing advertising for CVS is going to be very different than it is for the Aetna insurance. Engineering for unrelated, typically very small. I call it a zero. For related, obviously, you can assume that combining some of the engineering departments, you can get some savings. Now, when it comes to sales, so far I talked about the cost piece of it. When it comes to sales, it really will depend on the type of acquisition. So when you're doing a case study in the future classes, you got to think really, really hard is, can you justify there will be a sales synergy? For example, Amazon, when they bought Whole Food, Amazon using its resources and core competencies to get sales synergy for the Whole Food, which means combining Amazon with Whole Food, maybe the combined sales will be higher. Somehow they can use Amazon's core competency with the Whole Food core competency, and the combined core competency will be stronger and better than they were before as individual companies. CVS acquiring Aetna Insurance, for example, maybe getting sales synergy by somehow bundling the health packages, combining insurance premiums and prescription drugs, for the customers. Maybe you can have, more customers now because now you're packaging it and providing more value to your customers. On the working capital side, obviously, there are three components: inventory, accounts receivable, and accounts payable. So what are rule of the thumbs for synergy savings? In inventory for same industry, you can assume 10%. But unrelated, obviously, combining two companies really doesn't help you because you're basically going to make products in different factories anyway. So it really is a hard time making an assumption that combining two companies that are in a different industries, you will get inventory reduction. So you typically can assume very little to none. Accounts receivable, now just because you combine the company and made it larger, doesn't mean your customer is going to agree to pay you any faster. So typically there are no benefits for accounts yes for the same industry or the related acquisition. Because what's going to happen now is now combining it, you have a more buying power. You're buying it for two companies, you can go back to the suppliers and negotiate a better deal. For the same industry, you can get a much higher number, 10%, and for unrelated, 5%. And why is that? Because when you're in the same industry, your buying power is in both areas. The product, which means raw material you're buying, anything that is used to make the product itself. And the non-product stuff, other material that companies buy, like cost of, paper, the computers, any other services they get, those are called non-products, so you can get some savings. So in the case of same industry, you'll get both. You have an opportunity to negotiate prices with your suppliers for product, aluminum, steel, etc., but also for the non-product. For unrelated, it's only going to be for non-product. So assuming a 5% reduction is a plausible number. So now, obviously, we want accounts payable to go up, so it is subtracted in the working capital formulas. So now, overall, for Max Inc. is privately owned company, the methodology we will use, the enterprise value combined after synergy should be greater than the enterprise value of Gen Inc., Max Inc. minus price paid. And the driver for acquisition for this particular case is cost synergy, and the acquisition in the related industry. And that's the reason why, in the case when I provided you with the information, we are assuming, obviously, these assumptions that are provided to you in the case, and these are a good rule of the thumbs for a company that is in a related industry, which we are assuming that Max Inc. is for Gen Inc. The other thing to also point out, typically in the year 0, which is the year you are starting your project, you will not get a lot of savings. So don't assume you're going to get savings right away. Always allow a 1-year lag before you're going to start to see the savings. Because in the year 1 of acquisition and merger, there is a lot of chaos trying to combine things, trying to work things out. Especially there are a lot of workforce reduction, so there's a lot of stress, there's a lot of anxiety. So the productivity typically drops in year one. So should not assume any savings in year the first year, which I'm calling it a year zero, and then you can assume the savings going forward. And again, busy chart, but these are cut and paste from the Gen Inc. Part G. You got the Gen Inc., Max Inc., and then we added the synergy piece. The green portion does synergy calculations to see what that does. And then again, we calculate the valuation, enterprise valuation for Gen Inc., Max Inc., and combine and see what it means. And that helps us decide what should we pay for the Max Inc. as a company. So key takeaways from this one, obviously in order to enhance valuation, manager has to enhance key cash flow. All new strategies should be tested with the NPV greater than 0 at the hurdle rate, or IRR greater than hurdle rate. Again, hurdle rate typically will want it to be equal to ROIC, and ROIC should be higher than WACC. In a company that has had high ROIC, but they cannot find comparable ROIC projects, and they have abundant cash, they can use something lower than hurdle rate. For this one, I would recommend watching the strategic connectivity part 2, and economic value added. Also recommend watching the strategic connectivity part 2, where I provide some more detail in that. So overall, from a synergy perspective, for your strategies as you get into the future classes, you have to identify, is it a revenue synergy, is it cost synergy, or both? If it is cost, where is it coming from? Like we made some assumptions over here, and that's going to allow you to be able to figure out, is the investment worth it or not.